Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
So let me. I'm gonna shift gears here just a little bit, and we're gonna pull up another chart. So I moved charts to EUU. This is the symbol that I'm using. In this case, this is an index. It indexes the Euro USD, and the options available from the ICE on the Euro dollar exchange rate are attached to this symbol. So if you were on your brokerage account, you were looking for the options available on the Euro dollar exchange rate, Euro first, dollar second, much the way that it's priced in the spot FX market, then EUU, that's the symbol that you would use. You'd be able to find those options on that symbol. And you'll notice that there's another couple of very subtle changes. Over here on the right-hand side, we've got the exchange rate still looks, it's 134.14, except you'll notice the decimal place has been moved over to the right-hand side 2 places. But for all intents and purposes, it's the same quote. So, so not a big change. The other subtle difference you'll notice is that because the options aren't traded, or they're generally not charted as a 24-hour market like they are in the Forex is charted that way. You'll see little gaps in between each day's price movement. And for those of you who are Forex traders and haven't traded FX options in the past, that may be a bit of a surprise. It's a little bit of a change in the way that the look and feel of a chart when you look at the index like EUU versus where the options are based on versus the Euro USD charts that you're used to when you look at your dealer charts or something like that. Now, so one of the things probably the best thing that we could do is to start looking at the leverage between one position on the in the Forex versus a position on in a currency option. And let's use EUU as an example. Okay, so and I have another bias. So I have 2 biases I'll mention today. One is I definitely favor exchange traded products over off exchange traded products. But number 2, I do have a bias towards longer term investing. And when I say longer term, it depends on which audience you're talking to as to what that means. So with active investors, that means I'm generally looking for positions that are I'm not planning to make any big moves out of that position for maybe a month or 2 at least. And in some cases, I may be taking a position and even an options position that's much longer than that. So sometimes when you're talking to Forex traders and you say long-term, short-term to them may be a matter of minutes or hours, but it's a really expensive way to trade. And so I tend to kind of gravitate towards the longer term opportunity where in absolute dollar terms, your potential profits are usually much, much larger. And of course, you don't have all the costs of trading in and out over and over again. So let's contrast this. Let's say that we had been evaluating an option position versus a currency position. So we're thinking about leverage between the 2 kinds of positions as we start to think about what's our upside potential. And we'll use EUU as the example here. Let's say we were trying to make this decision, in the beginning of January, and we're planning to hold this position through, maybe the 3rd Friday in February. So we want to have, we may even be going all the way back to, so maybe a 2 months worth of time there. And the market moved, about 1,000 pips, which essentially equates to 10 cents. So let's just make our numbers real easy, okay? Let's say that we decided to short the Euro-US dollar exchange rate at 145, and we got out at 135. And we did this trade in the options market by trading the Euro-USD exchange rate option, which in this case was EUU, and we also did the trade in the spot market. So in either case, we made, we had 1,000 pips as a potential profit. Let's take a look. What I did is I worked up a spreadsheet that I'm gonna share that now. And by the way, as I share this, if you would like to work through this spreadsheet on your own, I'll have it posted to my site at learningmarkets.com. where you can just go get it. It's nothing special, but it did help to kind of break out, what does this really mean? What does it mean to be comparing these two? So let's talk about this, okay? And I'm going to start at the top on my spreadsheet here. I've just got Excel open, and I'm going to start at the top. In column C, we've got our FX leverage. So what does it look like from an FX perspective? And then in column D, I've got our option leverage. So what did it look like? And I'm making one big assumption here that I need to fill you in on. I'm assuming that our trade basically took us right to expiration Friday, okay? So it makes our math really easy if we can look at the option price as of expiration. So we're not trying to guess as to, okay, how much time value is left in this option premium, or is there any, or whatever it is. So it'll make our math a little bit easier. There are some variables that we have to deal with if we're not holding an option all the way through till expiration, but in fact getting rid of it beforehand. And in this case, we would be buying a put option because we're shorting. That's the equivalent of shorting the Euro-USD exchange rate. So buying a put on EUU would be doing a similar trade. So in order to control, so we're in the FX leverage column here. In order to control 10,000 units of the base currency. So imagine that it's like controlling $10,000 worth. Okay, so even though it's the euro, it's going to cost us $100. Now cost is kind of an expression here because the over-the-counter Forex is a lot like the futures market in that what you're doing is you're posting margin. This is where that leverage comes in. 10,000 units divided by 100 is 100. So we've got $100 that's going to require in margin. That means we've got to leave $100 in our account. That's kind of a good faith deposit against losses. And if the market moves 1 pip, so that's 1/100 of a cent. Each of those is worth $1 in value. So if the price actually does move from the second we enter this trade until the second we close it, let's say 2 months later, we made 1,000. It moved to 1,000 pips. That means that we would profit $1,000, which if we assume that our margin deposit was kind of like an investment, then that's 1,000% return. Not too bad. Not too bad. But so let's contrast this to the leverage in a similar, so the same scenario, but where we bought a put instead of with some couple sample prices, but we bought a put instead of the Forex currency, because this is where traders, especially Forex traders, get hung up, is on this particular part of the calculation. They get a little bit hung up on, well, what's the trade-off to some of the things I may be giving up, some of the flexibility I may be giving up? What are the benefits that I'm getting in return? We're gonna look at that. So now I just pulled a sample price. What I did, I looked at today. I looked out to May's expiration. All right, and I looked at the at-the-money option prices, and I saw one for $230 for May's expiration on EUU. And so that's what it would cost me to buy one contract of EUU, and the notional value is real similar. It's basically 10,000 units of the base currency, and so you can think about it in very equivalent terms. Now you paid, in this case, you did pay that $230 to buy that option. That's how much that put option cost in this example. Now the price moves 1,000 pips, so basically 10 cents. The exchange rate moves 10 cents. That option, if we assume that we were able to buy an option with an at-the-money strike price, meaning a strike price that was equal to the underlying price at that time, then the option would be worth about $1,000 at the end of that term. So all intrinsic value. So $1,000, which means that if we subtract $230, what we paid for the option, from the 1,000 we make when we sell it or get rid of it, and then divide 230 into the remainder, we get a 335% return. In both cases, it's a very extravagant return. I mean, this is why traders look at aggressive instruments like this. It's because we know that there is a X probability that you're going to have a successful trade. So you're willing to sustain the kinds of risks that active investing and aggressive investing entails. But the reason why we're willing to sustain those kinds of risks is because once in a while, these kinds of moves actually happen, and you're there to play the move. So the returns can be very large, potentially.
To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.